What's going on, guys? Welcome into another episode of Money Moves. As always, your host, Matty A, my co-host, Mr. Ryan Breedwell. We are watching a massive convergence of geopolitical chaos that has the markets all types of confused, but not Mr. Breedwell. He's going to break through all the noise today. We've got the threats of accelerating inflation. We've got structural shifts in wealth concentration hitting all-time highs. We've got the potential escalation of the Iran war looming, or maybe not. There's a lot of people that are saying a peace deal is happening, and it's going to be happening very, very soon. We've got global energy dynamic strains. We've got the American consumer sentiment update. We've got FOMC meeting tomorrow, Jerome Powell's last and final speech from the podium. We've got AI trading agents getting unlocked in the crypto world. We've got sales data, concerning sales data, or maybe opportunistic sales data coming out on single-family homes. We got a lot to cover. Let's dive in. So, well, you're heading off to freaking Europe here in a couple weeks. So
gone in Europe for a couple.
We gotta get all the wisdom and updates from you before you head off on your.
I'll still talk to you one more time before.
Yeah, we got you one more time next week before you head out. So obviously a lot has been going on. Before we dive in today, did you see, I thought this was pretty funny. I figured this would be a good, funny way to start the show off. The U.S. government is now accepting donations to pay off its $39 trillion debt via PayPal and Venmo.
I think that's been for about a year now.
Yeah. I saw them re-promoting that on their website. As
some people are going to give it too.
Oh, dude, they've already raised millions and millions of dollars. I mean, the fact that if you're already paying your taxes and you're overly ecstatic about where your money is going, that you feel inclined to go help do your civic duty and throw in on that $39 trillion debt, make a big dent.
Very smart that they did that because they knew people would just, but there's people that'll do it. Let's just do it. Let's open the net.
I mean, all I know is that list cannot have one person with an IQ over 80 that is thrown in on that. It's got to be like the grandmas and grandpas. And
I made a donation on the 15th.
Yeah, me too.
It was a
multi-six-figure donation. That really hurt.
So was mine.
That hurt.
They did it, and they were all anal about it being ready. And then they took like 4 days to take it out of my account. So I'm like, is it?
Oh, I know.
Did I send the wrong?
Yeah.
You know what I mean?
It's funny. We were checking the other day. I was like, are you sure you sent it to the right spot? Like, usually they're on the spot taking my money.
And then they got.
Oh, yeah.
Hello?
Oh, yeah.
Yep. The right person got that numbers.
All right. Well, let's get some updates first in terms of, before we dive in on the markets, let's talk about some of the geopolitical stuff that is going on right now.
Sure.
We've got the ceasefire between us and Iran has held firm. There was, talks of a convoy going out to Islamabad again and meeting with them. Trump called that off. There were some threats made over the weekend, pretty much the same playbook and kind of the, posturing that we've been seeing. Opening the week, we saw that oil jumped up above $100 a barrel again.
Yep.
And as of tomorrow, I think the 29th or the 30th, the 60 days of, call it the quote unquote operation that doesn't require congressional approval, is expiring. So how's the market digesting all of this? What are the thoughts around if there is going to be real lasting peace agreements solidified here? And obviously energy continues to be somewhat of the concern around maybe inflation creeping up a little bit. Is it more short-term, long-term? What are you seeing and feeling on your side of the street?
Feeling good, man. I'm feeling
Well, you're always feeling good. There's not much that rattles you.
Here we are on Tuesday talking about volatility.
Yeah,
And it just is, it's a beautiful thing. It's job security. It's a beautiful thing. I'm not really that, hey, let me get the drum out. Not that concerned. Pessimism in the market is a bullish indicator typically for large traders, hedge funds, and institutional investors because retail traders are typically wrong. Really,
majority of the time.
almost all the time.
Yeah.
So over exuberance or over optimism is what leads to like a melt up or, a cliff drop off in something. And I just don't see that. I mean, we have an indefinite kind of ceasefire signed with, Iran. So that's what the volatility was for. We haven't necessarily come to a finalized full end agreement, but they have been in back channels giving us letters and information on things that they want to do, and they're sending it to us while we're on U.S. soil. So we're in a very strong negotiating position. And another little sidekick today is UAE remove themselves out of OPEC and OPEC plus.
Yeah, for 59 years they've been a part of that agreement. Break that down for us real fast because, I think when people see and read that headline, right? Is this bearish? Is this bullish? How does this impact oil and energy prices? Like, what's the strategy behind it? You and I were talking
These are
about.
my guesses based on what should happen. The reason they were in OPEC and OPEC Plus was the cartel idea there is we will make sure none of us over or underproduce, we'll moderate each other at a level, keep oil prices stable so we all can get very stable projections on what we'll make every year. That's the basic idea without having to get overly complicated. What UAE is doing by removing themselves is essentially removing the cap on their production without anybody's say so and nobody to answer to for it but themselves. And so,
and I got what is that? And the U.S. was like, yeah, go for it.
Oh yeah, the U.S. doesn't care.
Yeah,
no, the U.S. doesn't care at all. Why do I think they're doing that? Well, I think timing wise, it conveniently lines up with the fact that they were attacked a few times by Iran and they're helping the U.S. put pressure on Iran, and they're doing it in a financially sanctioned way that's very roundabout. Iran makes the majority of their money on oil sales internationally. So the way that they can hurt them even further is by saying, we'll just force the price of oil down. We're at about $99 a barrel, $100 a barrel as of market close today. We'll just force it back down to the $70, $60 range. So now they're making 20 or 30% less overall, but UAE doesn't really care because as long as they're, above $50, $55 a barrel, they're making plenty of money to make their needs. So it's a roundabout way to apply more financial pressure on Iran. How would they do that? They're going to flood the market with oil.
Yeah.
Cheap, great oil that people want. And that is bearish, in my opinion. We should see oil prices start reacting pretty soon, if not immediately, in a downward fashion. That'll be bad for energy companies in the short term. But the AI play also is a big enough catalyst to support energy companies because their energy demand is very high. I just think they're going to cool off a bit, and rightfully so. So that's what I think is going to happen. Will it play out that way? I don't know, but it probably will and probably should play out that way. I don't know what Iran can do to pivot around that.
Well, they're already struggling with where to store all the oil because they can't get rid of it.
That's when they start lighting it on fire.
And then, with the blockade out there, they're kind of getting chokeholded on their ability to monetize the oil. And then if you have way more supply hitting the market, that obviously, is going to drop prices. That's one, they're already getting what was like $400 or $500 million estimated per day that the blockade is in place. Then you start seeing headlines like this with, OPEC, and let's just play that theory out of how you kind of talked about it, right? Like there's some major financial hardship that is hitting that country right now, which just weakens their posture and position in the overall, war board of how they're strategizing and playing this and what leverage, we as America has. So, I mean, if you're pro-America, I think this is, a benefit to us.
It's a good thing.
Right. And to your point of what you said, I saw this and it was almost to the T of what you said. If oil prices are above $100 a barrel and the Iran war isn't over, why are stocks at record highs? And I think you just touched on it, was this AI revolution has simply become so large that investors are viewing everything else as noise. I mean, the Iran war, you would think, would be this catalyst that so many people are scared of. And mind you, we've seen some volatility and some pullbacks and some jump ups, right? But at the end of the day, like, it hasn't led to some massive correction that many people were estimating.
Quite the opposite.
Some numbers here. The S&P 500 is up 9.9% so far in April, on track for its best monthly performance since November of 2020. This follows a 5% decline in March, the largest monthly drop since April of 2025. This rally has been driven by semiconductor stocks, which are up 37.2% month to date. Over the same period, Magnificent 7 stocks are up 16.1%. As a result, the S&P 500 has now posted 10 all-time highs year to date. If the index rises another 1 percentage point, that would make April the second best month in at least 10 years. So, overall, to your point, this whole oil dilemma and energy crisis and war, fears, the market seems to be shrugging it off pretty well.
Yeah, and I think at market close today, we're up somewhere around 4.1 or around that 4.1% year to date.
Okay.
If you had taken it from January 1st to now, so you're still, better than inflation, better than cash, better than most bonds, currently better than most real estate. You still would be better off just leaving the damn thing alone and stop trying to be the expert in areas that you're not. And that's where I don't get why people overcomplicate it, because I do get it is hard to pick. We do earn our keep by picking stuff and doing a pretty good job of picking, but after that, it's really not that hard of a game. You just don't sell it. Or when you sell it to buy other things at appropriate times. You don't just sell it because it's down. So yeah, the game is not hard, but a lot of people struggle to play it, even though the rules are pretty clear and laid out. Nobody wants to believe that it's that easy, but it really is that easy.
Well, let's talk about some of the potential catalysts that could create some headwinds here. We're going into FOMC tomorrow. We got Jerome Powell giving his last speech. Before we dive into some of these data points and get your take on it, do you think his overall tone is going to be hawkish, dovish? Obviously, last FOMC meeting, he was pointing at, private job growth not being where they were hoping to see it be at. There are still concerns about inflation and obviously the war and how that's going to get absorbed and showing up in energy and blah, 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 right? So it was a little more hawkish than people were expecting. Do you see him kind of having that same tone and sentiment on the way out? Do you see, I mean, we all think it's going to be, or we know it's going to be a pause. But what are you expecting tomorrow, and how do you think the market is, what's the market looking for?
Well, I think he's going to be somewhat similar to his last speech, which is tones of hawkishness with no...
Yeah, it wasn't like he was super aggressive.
No, with no really good undertones of dovishness. Now, they did close the DOJ investigation on him. And I'm wondering maybe
about that, or?
I'm wondering if they did that maybe to be like, let the white bird fly a bit. But I don't think that he's going to be. I think he'll be unwavered. Yeah. I think that he's going to be centerline and lean towards hawkishness with, hey, this could lead to, and it'll all be what ifs or what aboutisms type thing. But I don't think he's going to be very dovish, unfortunately. I hope I'm wrong, but I don't think he will be as dovish as I want him to be. And, I would expect the new Fed chair coming in to bluff their way through as mildly hawkish or center line, but come out the gate somewhat dovish in policy. But I don't know as well, and I could be wrong on that.
Well, yeah, I mean, in his hearings, I think people were a little shocked by how, I wouldn't say he was hawkish, but I think they were shocked by how non-dovish he was, which is, I think, what you have to be going in there, right? As unbiased as possible and not give too much. We all know the institutional capital can read through, one, the data better than anybody, and two, the sentiment better than anybody, and they'll front run any of those, comments, right? So like the Fed chair obviously has to be very cautious about how they say it, what they say. But we've seen some of these data points, which I think are supporting some of the concerns that people have on, and we're going to get your take on, what is it? Ken Griffith, his bear market call, and concerns around a major pullback coming, which again, we've heard many people saying that for quite some time now, who've also missed out on a lot of gains and growth in the market.
Yeah.
The U.S. continuing jobless claims this last week rose 1.821 million versus the estimate of 1.82, previously at 1.809. So again, nothing too crazy there, but things obviously ticking up versus down. We also saw that consumer sentiment in the U.S. hit its lowest level on record amid the Iran war. This marks the weakest consumer sentiment since data collection began in 1978, April of 2026.
Wow.
I thought that was interesting. And then this is another one that, we were talking a little bit about it, of fertilizer being a concern and issues that, again, your take on it, I thought was interesting, right? Because I keep hearing this, and I'm just going to say I don't know enough to like really have a stance on it. But as I was reading more into it, on fertilizer, and because of the lack of fertilizer, a lot of farmers saying that they're, cutting their crop and their yield on their crop and all this kind of stuff. So food inflation. Average inflation for food and beverage companies surged 7.9% year over year in March, which was the biggest jump in at least the last 12 months. This is up 373 basis points from 4.2% in February. The largest jump was recorded in tomatoes, vegetables, and diesel. Obviously, a lot of that driven by higher fuel costs, meaning full impact of rising fertilizer and plastic prices has not yet been reflected. So some people are saying food inflation is set to accelerate. Obviously, I think there's still concerns around energy costs inflating. Is this something that is just, again, noise, or that could be a concern going forward that could lead to increased inflation that might impact the markets and really overall the ability for the Fed to cut rates?
No, I don't really think it's anything. I just think the farmers are going to make a little bit less money. I don't know. It's as simple as that. Like, same thing that happens when, those same farmers pay gas prices when they're higher. They're not deep enough they're not an important enough cog to matter at that level. So yeah, I mean, they'll make less money and they'll complain about it, but that isn't going to really do anything in the long term.
So why don't we transition over to good old, not Ken Griffith, it was Paul Tudor Jones.
Paul Tudor Jones.
So Paul Tudor Jones says the U.S. is more dependent on equity prices than ever, and explains what a 35% correction would trigger in the economy. Let me see if I can kind of summarize this little statement here. So if you think about the periodicity of significant bear markets, since 1970, we get a mean reversion about every 10 years. He's thinking that we're in that timeline. Is this something that you think or see any of this as being any kind, I mean, obviously you can't speak in certainties, right? But probabilities of there being a recession, some major cracks in the market, the economy, are you seeing or feeling any bit of that, even though obviously we know you're the perma bull?
I mean, kind of respect him. He's a better bull than or bear that I would normally deal with. I think his main gig, or where he made his notoriety, was calling
He predicted
crash of '87.
He called it, yep.
Yeah.
He predicted the 1987 stock market crash and shorted the Japanese bubble in 1990 for over, for over 40 years. His flagship fund has had a negative correlation to the S&P 500. 100% of his returns are alpha. He said today's market has many similarities to 2000, the easiest bear market I've ever seen in my whole life.
Yeah, that's scary when people say that.
Yep.
I don't know. I don't think so. You know, that's how, basing how the market trades today based, off of how it used to is not, and has shown, especially in the past decade, not to be a good use of your time or trading time, or return on equity or capital. You would be doing things almost like, buying an older version of your car and expecting it to be an improvement. So, to me, that's where the fallacy lands when you have, people say things like that have, been 40 plus years or about 40 years on the nose since you've made a big call like that, or 37 since you've made a big call like that. Michael Burry called 2008 and he shorted NVIDIA last year and lost a shitload of money. So I think that you got to be careful when people make really big calls like this, because if you're super convicted on just the way you do things because that's the way you have done them and they have been successful, that's probably not going to work very well in the long term because of how fast things move and change now. And I've said it before, where we used to have dips, bear markets, and they would last about 2.8 years on the statistical graph. I mean, I've seen many studies on that. 2.8 years, it's how long it takes to hit trough to break even. If you're using the S&P 500, blah, 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 blah. Now it takes a few months. I mean, we go through a pretty much a correction in 2025. Not really, but almost. And it fully recovers in the same month. Then the last time we saw anything like that was in March of 2020. And why did that happen? Because people were sitting in front of their computers. That was the first insurgence of the retail trader. And then we saw them get tested again through a rolling recession in 2022 with high interest rates. Obviously, that further, you'd almost say, okay, well, the retail trader didn't come out. Well, yeah, they didn't have any money. They had no money to spend. It was all dried up while they were spending it and pumping the market all the way to 2022. Money dries up, nothing happens. Trump gets back in office. People are making money in different areas. The market gets, good momentum behind it. People start making excess earnings again. Boom, we start seeing dips get bought up again. It's retail traders. That's what it is. That's buying the dips. They chase it. It's their heroin dragon. They want it so bad because they're hoping to be the next story to say, hey, look, I got in on the bottom. I rode it all the way up and I bought basic stuff, but I got out the gate, I got instant gratification. That's why we don't have market cycles and have not had market cycles. And I don't think we will have market cycles like we had in the past anymore. Will we have volatility? Yeah. Will there be years of losses? Absolutely. Will they be as sustained as they have been? I don't think so. I just do not think so. Too many people want to make money too fast. So they will push their money around, and it's getting easier and easier and easier to do it because everything's digital.
Right.
So I don't see this. I don't see that if he's basing Mr. Jones. Sorry, I just heard that when I said that. If he's basing that off of old data or how it used to be, I'm gonna probably fade that and say I don't think so.
Yeah.
And I would not doubt the U.S. consumer or retail trader, just like they can consume crazy through a recession. We had record numbers even in 2022 in the holidays. They can put money to work if they really, 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 really want to.
Mm-hmm.
So, and people will. Leverage is also much more common now. And even though retail still doesn't use it as good as institutional money does, it's not a scary thing.
Yeah.
It's just not as scary. We have things like, Affirm, Klarna, PayPal over time, every bank, American Express, make a large charge.
Yeah, right.
So you can, you spread it out over 3 statements type thing,
Mm-hmm.
No interest. Leverage is the new, man.
Yeah, it is interesting.
Yeah.
I think he talks about it in this. Let's give just a quick listen. I'm not going to play the whole 3-minute clip, but let's give it a listen.
And when I say leverage, we're 252% of stock market captive GDP. So in 1929, we were, I think at the time, we were 65%. And then in 87, we got to about 85 and 90%. In 2000, we got to 170%. And now we're 252. So you can just imagine, if you think about the periodicity of significant bear markets, since 1970, we get kind of a mean reversion about, on average, every 10 years. When I say mean reversion, let's say mean reversion to the past 25 or 30 year PE. So if we did that here, that would be, and again, these are elevated PEs, way elevated what we thought beyond the 20th century. That would be say, 35% decline, or 35%. On 250% of GDP is 89% of GDP to a most wealth effect. Oh my gosh. 10% of our tax revenues are capital gains. They go to zero. So you can see the budget deficit blowing up. It's the bottom market getting smoked. You can see this kind of negative self-reinforcing effect. And so it's troubling. We're clearly inside of a debt bubble. In the stock market, we're over-equitized as a country, have the highest individual equity weightings in the history of the country. And then the real problem is, if you look at private equity in 2007, 2008, that was about 7% of institutional portfolios. Now it's about 16% of the institutional portfolios. Real estate's gone up. Infrastructure debts have gone up. We're so much more liquid than we were in 2008. So you have to be cognizant that when you think about.
Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Imagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple. Focus on first position asset-backed lending, just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. What's your take on kind of that unpacking? I mean, it was similar to obviously kind of what we were talking about leading into it, but do you think he has any valid points of concern as to why he's kind of taken that position and stance? Like, are we in the late innings of this amazing bull market that, might have us facing the reality of one of these potential pullbacks in the future?
No, I think we started, like I said, last year, a new bull market. I think we're at the 1-year anniversary of our current bull market run. And I'll just, again, even with the market's down, when this episode comes out, I'll just point to Monday. We just closed at all-time highs within 48 hours of this episode coming out. What I do think, without trying to talk fancy or sound like I'm smarter than I am, I try to do the opposite, is I do think we're getting a new Fed chair. I do know, historically, that once the new Fed chair gets in, there tends to be some volatility. And then I know that every time that has happened through multiple different market scenarios with multiple different things going on, the market's then done a pretty big upswing. So that's probably more of the camp that I'm in, is we hit an all-time high, market's digesting that it was correct on this ceasefire thing, and it's going to continue to monitor that and move kind of sideways on positive news. But really what it's looking for is this Fed chair to get in and give some direction on what's going to happen so that it can continue to forward look. Because we're in a little bit of a limbo where we don't really actually know what's going to happen, because the person that's giving us the information is leaving and the person who's actually in charge isn't talking. Very rare moment in time. So that's really what I think's happening. Call me bullshit if I'm wrong, but I don't think I am. And that's what I think is going to happen. I think we'll see a couple weeks of maybe some more volatility. Nothing crazy. We'll see downs and then back ups and then downs. But then once we get some direction on what the Fed chair is going to do and the market can then make its 6 to 12 month predictions on that, it'll start moving forward on that. And my prediction will be we will see a cut announced, hopefully in July. And I think that's going to really send, I don't know if it's going to send the market parabolic, but it's definitely going to send it up towards that 76, 77 range. And if we have any other good news, like with catalysts in the AI space or chip makers domestically, geopolitical risk calming.
Yeah, what is like best case scenario? This real ceasefire, peace deal, it's concrete, things kind of de-escalate, and I'm really curious to see if and when that happens, which I believe it will, how the whole global kind of narrative settles down a little bit. Obviously, there's a lot of investment. There's a lot of stuff that Trump has laid the foundation for, is already in motion, is, right around the corner, that if some of these things get settled down, like there could be some real, the golden age, right, that he's been talking about. What's best case scenario if all those things kind of go according to plan based on what we think could play out? You think we'll be pushing into that 7,600 range and we'll see a lot of optimism back in the market and the economy overall?
Yeah, I mean, some of the biggest bulls on the market have said, 8,000. So hitting 7 and 8 in the same year, which would be pretty crazy. But I mean, 7 to 8 is a teen percentage growth.
That's wild.
It's not that undoable. We'd have to have a big year.
Yeah.
But bigger years have been had. So yeah, we could see some really cool stuff. We could see people be very handsomely rewarded for being equity exposed and staying invested. My opinion is that we will not have that good of a year, but have a really good year and be around the 76, 77 range, which is like 10% up from here, which would mean we'd be about 14% year to date on the S&P. That's good.
I
can't be mad on, can't be. And that means that you'll, be up higher in other areas,
Yeah,
maybe
right.
of individual names, but that's not a bad year. And I don't know if people are mad about making 14% of their money, man, you're really addicted to gambling.
Yeah, right. Well, I saw the last 5-year performance of some of these assets, the S&P 500 over the last 5 years, let's call it 100% up. And you even mentioned earlier, like if that's not accounting for dividends and things like that. So if you factor that in, it's even nicer.
Yep.
Gold up 170% over the last 5 years. NVIDIA up 1,200% over the last 5 years. And Ethereum up 0% over the last 5 years. I think today Bitcoin is trading around the 76-ish range. A lot of bears are saying that there's still a pullback to come, and things are still going to have to find a bottom in this part of the cycle. A lot of bears say that it bottomed out at 60K, and that we're just seeing some consolidation here, and we're going to see a run back up after the peace talks get really finalized. What are your thoughts on that? Because I know you said you expect it maybe somewhere in the 50, 55 range. I've heard 40 to 60 range. Like, people who think it's going to drop say, hey, like 60 is not the bottom yet. There's still more to go. But at the same time, right, like nothing is certain. Those are potential probabilities. A catalyst like a peace deal and some really positive economic, trends moving in the right direction, 60 could maybe end up being the bottom. And could that lead to, bigger growth for Bitcoin before it finds a new bottom?
The bottom of Bitcoin is just wherever people are convinced that that's the lowest people will pay. Nobody uses Bitcoin. Again, people talk about how it does all this shit, but they never use it for it.
Yeah.
Have you ever
Yeah, I think the closest thing I saw in terms of a transaction that people could wrap their heads around, we're seeing Michael Saylor, I think he purchased like 2.7 billion more over the last 10 days. And then of course the market pulls back. Like, I think there's a lot of risk with how much supply he's holding. I think there's just a lot of still, again, I understand a lot of the arguments on both sides. So I'm somewhat unbiased to, I have a very small percentage of my portfolio in Bitcoin. And I don't even want to buy, a paper stock. I'd rather own Bitcoin on my phone. That makes more sense to me. I get those arguments being made, but I still think there's a lot of stuff that needs to get flushed out before people really feel confident in where Bitcoin is headed and how stable of an asset it really is.
Yeah, I agree. And I just think that if Bitcoin doesn't have a use case besides to transfer value, it's not the best at doing it, nor is it the most secure. So
Right.
why are we using it?
Yeah.
And that is all that eventually the fat lady needs to sing and be heard. And larger institutions, I think it's funny that people think large institutions are getting behind Bitcoin when they're not. They're just putting a basket out there and letting you put your Bitcoin in it and then letting them charge you a fee.
Yeah.
Without buying any of it or holding any of it themselves. They have custody of it on your behalf, but they don't own it.
Yeah.
They don't.
What about all the, companies that are, building up their treasuries and reserves? I mean, there's governments, there's companies, I could go, I don't know. I'd have to go do the research.
I don't think any, I don't know if we would call...
There are other governments around the world that have Bitcoin reserves, and
Bitcoin's price will probably pull back pretty significantly, and because people will be like, why do we own this? Like, Bitcoin was great because it paved the way, but we're all stuck on the original version of the technology thinking it's been proven that it's not.
Yeah.
And it has a lot of things good about it that have been taken and improved upon on other projects. And there's a ton of stuff that isn't good about it, which is why we have other options. Ethereum, Solana are ways to do what Bitcoin envisioned doing, minus replacing the US dollar, which will never happen.
I'm very interested to see how low it goes. Because when stocks, it's the opposite of what you should be doing. But when that fear and people start seeing it go down, 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 right? Like how far can it really cascade? That's where I'm interested to see, like, where's it really going to bottom out?
If Michael Saylor has to sell, it would be like catastrophic how fast the market would fall.
Talking about gamblers, Gemini launches agentic trading. We all know kind of AI agents and LLMs and people creating employees or, autonomous bots to go out and do things on your behalf. Gemini is the first to launch agentic trading. It allows users to connect AI models, including Claude and ChatGPT, directly to their trading accounts to autonomously monitor markets and execute trades via their MCP standard. They're kind of the first to do that. I think that's pretty wild. To me, that seems extremely risky with, one, how inaccurate, AI can be sometimes. There's so many little mistakes and errors that I catch on basic stuff, let alone very complex stuff with some of these AI models. And then to, give it access to your wallets and your private information and the amount of scams and hacks and things that are out there still. You got to be bold and, a little wild to do that. And that's interesting, right? If that works, let's just play that scenario out. If that works and AI is so smart and people just continue to win, there's no way they're going to allow that to continue. Like market makers will not allow you to probabilistically win more than you lose.
AI, well, they already flag people and shut them down when they can tell they're running AI bots or models and making too much money too fast.
Yep.
You have to remember, it's only replicating what a human could do if a human could work at those speeds.
Some room to be covered before we get there. Shifting over to the housing market and wrapping up here, U.S. housing market has reached its most unaffordable level in history. And based on some of the data that was just released today, U.S. home prices dipped in February for the first time since June of 2025. We also know that we have way more supply than we have demand right now. Home sellers have cut prices at a record rate per Redfin. And we're seeing overall a lot of markets have pretty significant pullbacks. So as I've been saying for, quite some time, this is a very interesting time if you are a buyer to get in and find the property that you're looking for and get the deal that you want. You may not get the rate that you want, but you can get the house deal and the term structure that you want. And you may just need to be okay with the rate in the interim for some period of time that you're comfortable with. But I have been seeing a lot of people get really creative seller financing structures. We're starting to see some short sales that have a really high mortgage that obviously bought at the peak of these values, and some of these values have dropped. Foreclosure and distress data is starting to tick up a little bit. So I found this today that I thought was pretty wild. $4.85 million Bay Area home for sale. The owner and the listing agreement. Did you see this?
No, but it says Bay Area home. It's going to be something wild.
Okay, so if you can see it on Zillow, it's a beautiful house, 4 bedrooms, 5 baths. The seller's a banker. The buyer, he wants is a 28-year-old Anthropic, but no cash. This used to be a joke. Now, literally, it's on LinkedIn. This guy was basically saying, I will trade you my home.
But
they're going to
pledged asset line of credit.
At the end of the day, yeah, I would say the beauty of real estate is you can get as creative as the minds at the table are willing to get. And if he owns that shit free and clear, and they can find a way, he doesn't have to worry about a mortgage, right? He's just
he'll have to get somewhere the cash will have to be created.
Right.
There'll have to be a loan against the assets.
Against the stock, right?
Yeah, pledged asset line.
Okay.
Of credit.
Yeah. So to Ryan and his amazing team, full portfolio, X-ray, connect with him, questions. Number one thing, obviously, is most people getting overcharged on their fee structure. If you want a free strategy session, text the word X-ray to 844-447-1555. We have the income fund open. If you want to be a bank with us and become a part of the fund, 10% interest annually, paid out monthly or quarterly, whatever you prefer. Collateralized assets, very simple, boring banking fund for you that are looking for some passive income. So, as always, we appreciate you guys tuning in. Keep investing in yourself and your wealth on your march to $1 million and beyond. We'll see you guys.